on this. Actually, you know what I'm gonna do? I'm gonna cover it up. So if you don't want your name to come up, don't get into the chat yet. Okay, so we're recording now. Welcome, guys, and we are going to talk about, as I said, the secret sauce of gold. Now, I've done two. I promised 2 weeks ago to do gold and Bitcoin or crypto and Bitcoin. So Thursday now I'll be doing the same equivalent with Bitcoin. I will tell you, when I looked at the AI stuff for the secret sauce stuff when it came to HFT and quantitative stuff on Bitcoin, I basically came away with saying, yes, it is manipulated, like heavily manipulated. Not so much manipulated with gold, because gold is a lot stricter, falling under the CME. But Bitcoin on other exchanges like Binance and Deribit, yeah, you can easily manipulate it. So I'll just leave it at that as the prelude to Thursday night. Okay, let's get started. So what I'm going to talk about is the different types of options. In this presentation, haven't really stressed that the two primary asset classes that are traded in gold um, is options and futures. Okay, nothing else, not ETF, no retail, anything. This is where the basically it's a derivative market in which a lot of these shops operate in. So that falls under futures and options. So okay, so what we're going to talk about here is why. I mean, it's pretty evident why people want to trade gold. I'm going to talk about high level on the different types of option strategies you can use with particularly micro gold, but it's the same with a full contract in the futures. You can also do a variety of other options. So we'll kind of cover that. But it's very high. This is a high level. I can't go very deep into it, obviously, because of, you know, usually people drop off after an hour. So I don't want to go too long in that. Then I'm going to talk about my usual workflow on creating a Streamlit app in Python and then be able to take that and then turn that code around from the Streamlit and then turn it into basically a, a bot, an automated strategy in C++. And that's going to have all the high frequency trading logic built in. It just depends on how you build it or how you prompt it and which LLM you use. And then at the end, other options as well. So let's go to, I'm not going to spend too much time on why gold. Everybody knows gold's value is stored, it's an inflation hedge, and it's safe haven, blah, 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 blah. So obviously, when do people look at market conditions? One thing I'll say about both gold and silver right now, if you look at the pace of how it's accelerating in the last 2 weeks, it's really accelerating. And it's moving up very quickly, both silver and gold. There's obviously something going on in the economy and the markets, global markets, where just people are diving into gold like crazy. The U.S. markets are also going up as well, but gold is well, we already know it's sound money and all that, so I don't need to spend time on that. But there's a couple of things here that people might not know is with gold, and when it comes to trading in the world of options, you can trade off of the volatility on the time decay on an option. Just so you know, also uh, part of gold is really good for managing risk really effectively because it's fairly low volume as well, and it's kind of predictive as well. So when you look at uh, gold against other fiat currencies, it's sound money. I mean, all the standard currencies out there are built on debt when the US came off of the gold standard in the early 70s. Um, they can also counteract equity market volatility. And the best part about it you can diversify into it. Now, from a options or a futures standpoint, if you're trading from a really small account size, you want to trade in the micro because it's 1% of the full contract, and the other one you can do is obviously silver. Different market, they're very kind of similar, but I haven't really dug deep into the silver. Now, if you want my honest opinion, if I was starting from, which I will be, I should say, if you're going to start from either or silver or gold, and budget or your account size is limited, I'd probably kind of do silver over gold. Everyone's going to have their own state, their own opinion on that, but it really comes down to to the account size as well. If you guys got any questions, just type them up in the chat. Okay, so let's talk about the different types of strategies available, specifically in the world of micro gold, and this involves both futures and options. So, a couple of things you can do here is you can do short put vertical in a strategy. So this is obviously fairly advanced. So what you're doing is you have a strategy, you're putting out a put option, and you're buying the lower strike price to define your risk and capture the premium. So on the risk management side, you're buying the lower strike price, but it's limiting your downside losses. Now, the only reason gold may go down is because of if like right now, what's happening in the markets is in the markets right now, uh, gold only go down when the equity markets go up because obviously they counteract each other. So if you start to see equities go up, like stock market go up, obviously that's going to have a kind of hit on gold. But in this cycle, I'm not sure if that's going to continue because just of the concerns there are globally in terms of where we're at with the market and if the markets do collapse, as they say, it might in the equity space. So gold is definitely going to continue, but that's the only time when gold goes down as part of that. Okay. Okay. So what we can do here just generally is the K premium. I never even heard of this until I started playing with AI. So if you look at it just from a general high level portfolio management view, a lot of portfolios are set up, especially if you're going into retirement, that there would be, let's say, dividend income as one of the primary sources of income from a portfolio. What's happening is because the equities are or the stock markets are getting bad, a lot of companies are either going to start reducing their dividend income or may cut it altogether. So what a lot of the bigger portfolio managers are doing, they're focusing on in the ETF space is to start selling covered called ETFs. So that's the same thing as what it says here. If you're in the option space and you're going to write an option or sell premium, this is just a really uh, I don't know if it's not low risk, but it's a lower risk but a higher reward to collect income. Okay, but from a trading point of view, if you do sell an option or a premium and that position goes against you, you better be prepared to cover your losses to sort of like cover the other person that's buying your premium contract. So there's a lot of big focus on that now to sell premium or cover calls. So you can short these puts on the verified vertical spreads, and then you can profit off of that time decay. And then out of that, because there's more stability in the stable in the gold market, it might be safer way to kind of do this. And gold and silver are the better um, assets to do this with because they don't have the crazy volatility that comes with um, comparable to other assets like obviously Bitcoin because it's a lot riskier and the volatility is much higher as well. Okay, so that's kind of covering the options side of everything. So if you want, we can kind of go back to it if you got questions on that in the chat. All right, so here's a couple of other things that is the secret sauce stuff. So when you're working with call it HFT, secret sauce stuff, the high frequency trading secret sauce stuff. Everyone seems to think that there's just one general algorithm that will make you go from rags to riches. From what I've learned over the last few weeks, it's a combination of about 3 to 4 different algorithms. Like you have an algorithm set up for risk, you have another algorithm for sentiment. You have another algorithm watching open positions. And then you have your actual strategy, your core strategy. So you're going to have a multitude of about four separate algorithms running in parallel to watch all of these different factors in a portfolio. So one of the big things to watch for that is pretty classic at the high frequency trading level is order book imbalance, which is like a call put parity. And when that gets out of whack, that's when the HFT shops will step in. And this is done at a blink of an eye, okay, because there's this highly limited opportunity for them, and they can do this day in, day out. They can also apply market making on top of it, and da da da. It gets very complicated. And the other thing, what they'll do is they'll analyze the implied volatility surface. So you can forecast from that as well. You can do this across all futures and option instruments across all the major exchanges, and there's about obviously 40 plus in the CME. And yeah, there's lots of opportunity there, but again, it's done at a quick split level, nanosecond, microsecond level. And then more for the retail trader, there's the macroeconomic indicators as well, supply, demand, that sort of thing, risk management related, and all that. So you can do that as well. But again, I'm not getting into that because like we have a very limited time here. But just a high level, you can do that. So this is what I've developed, and from the AI and other shops do this as well. From what I'm learning, what they'll do is they'll take a trading idea and they'll turn it into a Streamlit app, which is basically a Python web front framework. And what they do is you can actually take, and this you can generate all of this with AI. You can take your potential trading idea or combination of these options and futures and compare them against other major assets, namely in the ETF space for, let's say, back testing purposes. So you could compare TLT, which is the Treasury, the 10-year, gold, SPY, which is your S&P 500, or QQQ as well. Here you can overlay that with this potential type of strategy that you're looking at, ask it to back test, and even with arbitrage, you can add in other ETFs as a comparison to your option or future positions that you're looking at as a strategy. And then the other thing is just by prompting it, you can just ask, give me a back test in the prompt. And what will happen is it'll give you all that historical. And then you can, with sophisticated prompting, you can definitely see which is the better way to go. If gold is in fact the better way, and you can forecast it, and then at the same time you could do that same comparison to all the other major ETFs or whatever you want. In fact, but as example like TLT, buy or QQQ as just a comparison. Um, so here, what we're doing, and this is getting into the mindset of portfolio managers. I had a call with somebody earlier today, and people seem to think the most lucrative place to go in trading as a career is going to be quant research. It's not quant research. I also saw an article on LinkedIn that had, complaining about, well, quant researchers are the ones that come up with the trading ideas, but why do all the traders make all the money? It's because the traders, namely the portfolio managers, are the ones putting the risk on. Okay, like these quant researchers are highly paid to bang out trading ideas, but it's the portfolio managers that are making the most consistently run decent portfolios consistently, so they get their rewards are the highest you can get anywhere outside of management in any of these big investment firms or hedge funds, whatever you want to call them. So what I'm trying to stress here is we're looking at trading from a portfolio manager perspective, because once you start to look at that, that puts you in a position where you can start going, aha, I can proceed with this strategy idea, like I'm saying here with micro gold, and be able to see how it compares to other potential other strategies and other major markets. If you guys got any questions, just let me know. So what we're looking for from that perspective is the top three things I'd consider is annualized return. Um, over the back testing. I think somebody's got a question here. Okay. Yeah, here. Thank you for sharing. Enhancement would be able to share your PowerPoint. Yeah, I'll be able to share PowerPoint as well. No problem. Um, there's the three major things from a portfolio analysis. There's annualized return, which is the big duh. Um, See, everyone's going to look at volatility, current or past volatility. What's most important is to look at implied volatility. And you only get that from options. Okay. That's why options is so critical because you can use the options as your forward leading indicator. Okay. Everybody looks at what's happening current or from the past. And as we know, what happens in the past does not dictate what happens in the future if the momentum shifts. So that's why implied volatility is very critical. The other thing that a lot of the portfolio managers will look at is maximum drawdown as well, because if you look at Bitcoin, you go, "Oh, I'm doing great in Bitcoin," but you're taking a 20% drawdown. That is not exactly the smartest way to trade. Now, you could tell that to the retail world or the dumb money basket world, which is majority of people. They'll argue it, but they will never ever consistently profit in a safe, predictable way. Any other questions so far? Okay, let me just make sure I'm not skipping anything. Okay, so the other thing that we got to worry about is commission. One thing I forgot to mention that's very, very important. I spent 3 day and night days since Friday up until last night, Sunday, uploading about 90 plus projects in Python. Those projects came from, I'll just say, industry related trading ideas. And it's very important to understand this. We are moving into an economy, a market that's very uncertain. They predict there's going to be high levels of volatility, unpredictable volatility. There's going to be so many market regime changes happening in the market as well. And if you're coming from the world of traditional trading and investing, like in the world of technical analysis or fundamental, you're not going to last over the long run because of the unpredictable volatility. So there's a huge focus on trying to be able to look at a portfolio and, as I said, be able to look at implied volatility and kind of gauge where that implied volatility is going to go. There's a huge stress on that, and there's just so many other new concepts in the world of quant that are being introduced in the last year. And I've uploaded quite a number of projects related around those new ideas. And the big one is the unpredictable volatility. So that's really important to know. The other thing that's important to know, if you go down this path, depending upon your account size, the other big factor a lot of people do not really uh, uh, calculate or interpret is that when they put out trades, depending upon their type of trade, you can get that trade snooped on by these big operators and have all your open positions be traded against, and you wouldn't know it. Good example, Robinhood. I'm sure you know about the order flows being sold to the likes of Citadel, and Citadel will monkey around with those open positions, depending upon the volume of them, and they'll trade against them. Again, the retail world will never know about that. Just one example. So they have to be very cognizant of their market impact when they do these type big trades or block trading, as the industry calls it. So there's those sort of things you have to understand, and you have to always, always factor in your commission as well. I was just talking to Predrag about a, a broker I'm looking at called Iron Beam out of Chicago. They have free data, but they're very, very expensive on the commission fee. Okay. So whereas, okay, I'll pay a little bit for the market data and then go after brokers that have the lowest commission. So you think, maybe interactive brokers might be the solution. Well, from my research since last night, the best one to go with is Sierra Charts. So I'll be doing a lot of heavy investigation on Sierra Chart, the platform, and go with their own native order routing and own data as well coming back from the CME. So that's a route I might go because they have apparently the lowest commission fee and the lowest data cost. So you have to factor those things in as well. I know I'm rambling. Anyway, so the micro futures is really good when you're working with smaller accounts as well. and you can also factor in your market conditions as well. Okay, so the big driver here is C++, how to build out, like I said, high frequency trading, like mindset, we'll call it. Um, the thing is that, uh, and again, I picked these up from AI, doing a lot of deep prompting on AI LLMs that tell you stuff that a lot of people may not realize that it can do that. So a couple of things that can happen is coming from the world of C++, and I'm going to get a little technical here. You want to have non-blocking minimal dependencies. So that basically means you have reduce as much blocking, which reduces as much latency as possible. You want to keep the coding size as minimal as possible, meaning no dependencies, only the standard template library. You also have to really be aware of the best event-driven architecture options out there, and I've already mentioned the minimal dependencies as well. So, there's a number of other things as well. I know it gets kinda complicated, but when you wanna do this kinda lucrative trading, there's a lot to learn here. Um, so the thing is, when it comes from the strategy itself, there's the put verticals, as I mentioned before. Now, this is a kind of dated. I created this slide deck like last week. I think my mindset's going to change on this, but I'll gladly talk about it. So obviously, you have to have a real market data streaming subscription. Usually it's going to be from the broker, but if you're going to do what I'm trying to do, have a P&L on a broker account like Interactive Brokers, and at the same time you're having your broker deduct money out of that account, and you're trying to showcase that P&L as a way to verify trades. That's not going to work for me. That's namely with Interactive Brokers. So I have to change everything and not go with Interactive Brokers because of that. I'm also learning some negative things about Interactive Brokers through the Sierra chart as well. The short put of the short put vertical spread trading we already covered. So when it comes to Interactive Brokers, apparently there's some unreliability when it comes to executing your trade through something like EWS. So I kind of knew about that, but I have to kind of like dig deeper into that because that's going to have a obviously a negative impact on your trading. And again, it comes back. Is this a duplicate? Sometimes I do this to myself. Okay. So, yeah, we've got there. Okay. So some other things to be aware of. You definitely in this kind of market want to find delta neutral, risk-free type of strategies. Um, and a couple of things as well, especially when it comes to C++, you can't kind of really do with Python is parallel computing. So you probably need to have some kind of heartbeat monitoring on all these type of setups, and you will start up paper trading, okay? And with the AI, that can help um, expedite that process as well, because part of the back testing as well. You can add that in, as I said earlier, with the Streamlit application, and AI is very good at that. Okay, so there is obviously limitations. Any questions so far? Let me just see. Oh, yeah, good question. Let's talk about that. AMP futures. Yeah, with the AMP futures, I can't really say yay or nay on it so far. I know AMP futures is the most popular, obviously, but I think part of the problem there, and I think they do support options. So that's something I kind of look at, but it's kind of early for me to give you a proper answer on that. Um, so another question was for Forex, which broker is good to open account? Now that's for Kodacar. So okay, so that depends how you define as Forex. If you're talking about retail Forex, what I'm talking about is very different. I'm talking about futures and options. When you're dealing with retail Forex, you're going to probably lose money just because of what I've already mentioned when it comes to the trade hunting and all that. So your own broker will do that. and they can get away with that because they don't have the regulation. And if they try to implement it, usually they can get away with it, especially if you're dealing with a overseas broker out of, let's say, the Caribbean or something. So you have to be very careful of that. I wouldn't go with retail forex anymore, because you can trade options and futures in a regulated market, because the CME, which is regulated by the CFTC out of the states. Nobody's going to monkey around with anything on their operation in terms of as a broker. They'll get booted out of the CME, and that's a big deal. So that will most likely and pretty well not happen at all. But whereas with the forex, retail forex, I don't want to mention names, but a good example was what was the name of that? FXCM. They got booted out of Ontario because they monkeyed around with people's orders, and they got booted out of Ontario, Canada. I think as a result, they got booted out of Canada as well. They still, and I think they got heavily fined within the states as well, and they can't operate in the U.S. as well. That's many years ago, but if you're working with those kind of so-called, in quotes, reputable brokers, and that can happen. That just says something right there where I wouldn't trust them, and you have live money on that, so I wouldn't go that route. Whereas if you are interested in currencies with futures and options, that's definitely an option. I think my next one of my next topics will be what I'm doing here with the gold and Bitcoin. I'll be also doing same thing with a couple of currencies as well. I'm not sure if that answers your question at all. Just let me know. A couple of things I will say about when it comes to currencies. Uh, the two that I'm seeing that are kind of traded in the futures world. I mean, this is about a week or two ago. Australian dollar and Mexican peso look pretty good. I think just lately the Australian dollar has been kind of getting sold off, but Mexican peso may still be okay to trade. And the reason that might be good is because their margin requirement is very low, because no one is trading that. And a lot of traders, from what I'm seeing right now, are looking for carry trade. I'm not seeing a lot of the Japanese yen. I'm still kind of seeing some Turkish lira, but I think the yen is kind of risky because it does hurt the Japanese economy, and they are running on their last mile on using their yen as a carry trade. I think they're getting penalized for it as well. That's why my scans don't come up with the yen. Also, like Mexican pesos looking good. Brazilian real. I don't think you can't get exposure with that with through the CME, but the Brazilian real looks really strong. Um, their economy looks pretty good as well with the Brazilian everything. Their exchange and their currency looks pretty good. Anybody else got any questions? Yeah, I think we've been going half an hour here. Yeah, half an hour. So comparative with what I'm stating here versus Bitcoin. Um, yeah, I don't think the manipulate there is don't think there is any well, there is manipulation at the trading desk within the banks. But I don't think they're going to go about it the way gold is performing right now, because they'll be heavily fined. But the other thing is Bitcoin, if you come out Thursday night, you'll get a different type of presentation, and you'll see how a lot of these firms, the dodgy high frequency trading firms, will take advantage of the retail crowd in that space, and crypto, and just and Bitcoin and Ethereum and all that. It's been verified through the AI that, yeah, they do manipulate the trading, and they can have huge impact on it. And just watching charts and all that's not going to cut it. You guys got any other questions it up? Oh, I got a yup on that. Oh, I'm sorry. Any other questions on that? And as I said earlier, if anybody's on my email, I'm looking at doing a 7-day trial for my quant analytics. So if you're interested in that, just let me know. If you want my email, I'll give it to you right here. The chat. It's feedback@quantlabs.net. So if you want to capture that, there you go. The email if you want in on that. I'm not sure if I'm going to do that forever. I just want to test market, see if there's an audience that comes out of that. And anybody else got any questions, concerns? And as I said, I'm going to be doing a similar presentation. The outline will be completely different. And if you come to that, you will probably be convinced that Bitcoin might not be the best asset trade um, because of the manipulation there. It's great. You can build a strategy that can watch Bitcoin, and then when the market moves and you get signals back that it says yes, Bitcoin's ready to move, you could do very well. I mean, I'm not sitting here saying don't trade Bitcoin, but I think there's just better asset classes or instruments like gold, silver, much better than Bitcoin for sure. Anybody got any questions or comments? If not, I'll do it going once, twice, three times as well. If you got a question, just type away as fast as you can, and I'll gladly jump in to respond to it. So do it going once or going 1,000 or going 2,000, 2,500. Okay, going 3,000. I guess we're done. Okay. Yeah. So leave it that. Okay. So any of you guys got any other? Well, I guess we're done. What am I saying? All right. So I'm gonna call it a night and kill the presentation. Thanks for coming out. I've given you my email, feedback at quantlabs.net, or just join my email newsletter. And yeah, thanks for coming out. I don't see anything in the chat. All right. Thanks for everything. If you need the PowerPoint, just get in touch with me and I'll gladly send out the PowerPoint to you. Okay. Have a good day.